Have you ever wondered how we decide what something should cost months from now? It is tricky because every asset, like gold or wheat, has its own personality. We call this futures pricing. There is no one-size-fits-all method because supply and demand patterns change constantly and different assets have different cash flows. Today, we will focus on the two biggest ways experts figure this out: the cost of carry model and the expectations model. Let's start with the cost of carry model. You can also call this the no-arbitrage model. It is based on a simple idea. In a smart, efficient market, there is no such thing as a free lunch. If the price for the same item is different in two places, traders will jump in immediately to buy low and sell high until the prices match. In the world of finance, you can either buy a stock right now in the cash market or lock in a price to get it later using a futures contract. In a perfect world, the cost of both should be exactly the same. So, how do we find that perfect price? We call it the fair price. You can think of it like this. The fair price is basically the current cash price plus the cost of holding on to that item until you need to deliver it. It is like buying a gift today but paying a small fee to keep it in a locker until a birthday. For financial assets like stocks, this might include bank fees or financing costs. For commodities like oil or gold, it also includes warehouse rent and insurance. The golden rule is that the cost of buying it later must equal the cost of buying it now and carrying it forward. To make this stick, let's look at a real world example with gold. Imagine the current spot price for 10 grams of gold is 62,130 rupees. If it costs you exactly 100 rupees to store and insure that gold for 3 months, then the expected fair value 3 months from now should be 62,230 rupees. But what if the market is actually offering a futures contract at 62,280? That is a 50 rupee difference. This creates an arbitrage opportunity, which is just a fancy way of saying a risk-free profit opportunity that traders will exploit until the prices align again. This brings us to how markets fix themselves. If the futures price is higher than the fair price, people will borrow money to buy the physical gold and sell the futures. We call this cash and carry arbitrage. This extra buying makes the cash price go up, while the selling makes the futures price go down until they meet. If the futures price is too low, the opposite happens, which we call reverse cash and carry arbitrage. Traders sell their gold now and buy it back in the futures market. Either way, the market eventually finds its balance, restoring equilibrium. Now, in the real world, trading is not totally free. There are taxes, commissions, and small fees. We call this market frictions. Because of these costs, the price can wiggle around a little bit without triggering a trade. Think of it like a safety zone. We call this the no arbitrage bounds. If the price stays inside these bounds, the mispricing is too small to cover the costs of trading, so it is not profitable to act. The lower these costs are, the narrower the bounds, and the more efficient the market becomes at aligning prices. Sometimes holding an asset actually pays you. For example, if you own a stock, you might get a dividend, or a bond might pay you interest. We call these inflows. To find the true fair price, we take the cash price, add the cost of carrying it, and then subtract any of those inflows you receive during the holding period. Mathematically, we use a formula where the fair price equals the spot price multiplied by 1 plus the interest rate minus the dividend yield. It is just a way of adjusting for the extra money you earn while holding the asset. Let's try this with a stock index. Suppose the index is currently at 17,500. If the cost to borrow money is 12%, but the index pays a 4% return, we have to do a little math for a 90-day period. After calculating for those 90 days, out of a 365-day year, the fair price comes out to 17,835.26. If the index futures are trading higher than the model value, say at 17,848.63, it is a signal to buy in the cash market and sell the futures to lock in a gain. For this model to work perfectly, we have to make a few assumptions. We assume there is an abundance of the asset and that demand and supply stay steady without seasonality. We also assume the asset is easy to store and that you can sell it short without any restrictions. Finally, we imagine a frictionless environment with no taxes or trading fees. It is like imagining a perfectly smooth road with no traffic and no tolls. In this ideal world, prices should always follow the formula perfectly. Of course, reality is often a bit messier. Some things, like agricultural crops, are seasonal and their prices drop when the new supply arrives. Also, if an asset is not storable, the model simply does not work. Short selling can also be impossible for certain commodities. This is why the cost of carry model is actually a better fit for things like forward contracts or financial assets rather than seasonal groceries. For specific assets, we usually have to tweak the rules to match how they behave in the real world. One of those real world tweaks is called convenience yield. This is a perceived value or mental comfort you get from physically holding an item during a crisis. Imagine a natural disaster like a flood is coming. Even if it costs money to store grain, you feel much safer having it in your own silo rather than just having a piece of paper promising it to you later. This human tendency to hoard during scarcity creates an immediate demand in the spot market. This hidden benefit is an intangible inflow that people are willing to pay for. When this feeling of security is very strong, it can actually dominate the cost of carry. This can make the futures price trade at a discount compared to the cash market, which we call an inverted market. In these cases, the standard model breaks down because nobody wants to lend out their scarce supplies for reverse arbitrage. You see this often with consumption assets like oil or energy during a shortage. But it is very rare for financial assets like bonds or currencies. Since the first model does not work for everything, we use a second one called the expectations model. This approach says that the futures price is simply what people think the cash price will be in the future. It is like a giant poll where every participant votes on where the price is heading. This is especially useful for assets that are hard to store or can't be sold short. Here, the futures price acts as a price discovery mechanism, helping the market guess what the future direction will be. Finally, these expectations tell us a story about the market's mood. If the futures price is higher than the current spot price, we call it a contango market. This suggests people expect prices to rise in the future. On the other hand, if the futures price is lower than the current price, we call it a backwardation market, which means people expect prices to fall, whether it is a premium or a discount. These futures prices are the market's way of signaling its collective sentiment about where prices are going next.